Stop. Look around you. The world you inhabit right now, your job, your investments, the entire global financial structure, the very social media algorithm that brought you to this video. It is built on a lie, a beautiful, comforting, and utterly devastating lie. We are all trapped in a state of tranquil, predictable delusion. We look at the past, draw a neat line from point A to point B, and confidently project it out into the future. We believe that tomorrow will look largely like today, perhaps a little better, perhaps a little worse, but always within the bounds of what we can comfortably imagine. But what if I told you that the most important life-altering, wealth-creating, and wealth-destroying events in human history, the rise of the internet, the 9/11 attacks, the 2008 financial meltdown, the overnight explosion of Bitcoin, the sudden collapse of a major hedge fund in a week, the birth of the COVID-19 pandemic, were not just hard to predict, but were, by their very nature, impossible to predict? What if I told you that focusing on the probable is a guaranteed path to failure, and that your life, your portfolio, and your entire future will be defined by the highly improbable? This is the gravitational pull of the Black Swan, and once you see it, you cannot unsee it. We are living in an age defined by extremes. The Robinhood generation, the relentless crypto hype cycle, the FIRE movement aggressive pursuit of early retirement, the dizzying speed of social media financial gurus promising 10x returns. Every trend is amplified, every asset is leveraged, and every emotional panic is broadcast globally in a single second. This high-octane, dopamine-fueled financial environment is a breeding ground for Black Swans, those random, unexpected, massive impact events that render all your spreadsheets, all your historical models, and all the expert advice utterly useless. The only way to survive and perhaps thrive is to fundamentally change how you think about risk, knowledge, and uncertainty itself. This is a philosophy we must explore, the worldview we must adopt, if we are to escape the fate of the unwitting financial turkey. The author in the history of a cult classic, the architect of this paradigm shift, is Nassim Nicholas Taleb. Taleb is not a traditional academic, nor is he merely a talking head. He is a Lebanese-American scholar, a former quantitative trader, a statistician, and a genuine philosophical provocateur who has spent his entire life studying the nature of randomness, probability, and risk. Taleb belongs to a lineage of thinkers, but he is fundamentally a practitioner. He was born into an influential Greek Orthodox family in Lebanon and witnessed a sudden, violent outbreak of the Lebanese Civil War in 1975. A stable, predictable life was shattered overnight by an event that, in retrospect, seemed inevitable, but at the time was completely unthinkable. This experience gave him a lifelong, deeply personal understanding of how easily systems can break and how quickly the improbable can become reality. Before writing The Black Swan, Taleb was a successful professional in the chaotic world of finance. He was an option trader, a quant, who specialized in dealing with rare, high-impact events. His trading career wasn't about grinding out small, consistent wins. It was about designing strategies that would profit massively if, or more accurately, when a massive, unforeseen market break occurred. He made his name and his fortune by predicting the inevitable breakdown of risk models. Crucially, Taleb and his firm, Empirica, actually profited significantly during the stock market crash of 1987. He had built his entire strategy around the understanding that what the models called impossible was simply an eventuality waiting for its cue. The Black Swan, The Impact of the Highly Improbable, was originally published in 2007, a year before the worst financial crisis since the Great Depression. The timing was not just fortunate. It was prophetic. As a meticulously structured, highly leveraged global financial system buckled and collapsed under the weight of unforeseen mortgage defaults, a 3 sigma event that should have been statistically impossible, Taleb's book became a screaming siren that people finally had to acknowledge. The book immediately shot to the top of the bestseller list because the world was watching a perfect, textbook Black Swan unfold in real time, validating his entire thesis. The phrase Black Swan itself is an old concept. Before the discovery of Australia, it was a common European saying that all swans are white. It was used as a philosophical metaphor for an absolute impossibility. The certainty of white swans was taken as fact. But when Dutch explorers found black swans in Western Australia in the late 17th century, the seemingly immutable truth was instantly and irreversibly disproven. A single observation invalidated centuries of perceived knowledge. Taleb took this historical anecdote and formalized it, defining a black swan event by three key attributes. Rarity. It is an outlier, as nothing in the past can convincingly point to its possibility. Extreme impact. It carries an extreme, game-changing impact. Retrospective predictability. Despite its outlier status, human nature compels us to concoct explanations for it after the fact, making it appear less random and more predictable than it actually was. This is the dangerous psychological distortion Taleb calls the narrative fallacy. This book is not about financial modeling. It is about epistemology, the study of knowledge. It is a fundamental critique of the human mind's tragic flaw, our overconfidence in what we know and our blindness to what we do not know. It is the ultimate manifesto for the humbling power of uncertainty. The book's relevance to the modern financial zoo. Why is a black swan not just relevant, but essential reading for anyone navigating the markets today? Because the current financial ecosystem is the most fragile, leveraged, and emotionally volatile system ever created, and every structural component is designed to amplify the next unforeseen shock. 1. The FOMO culture and meme stocks. The rise of the meme stock phenomenon. Think GameStop, AMC, or other sudden internet fuel pumps is a perfect, modern example of black swan dynamics. No fundamental valuation model could have predicted the surge. It wasn't based on earnings or discounted cash flows. It was based on an unpredictable, viral, decentralized movement fueled by social media and low-friction trading platforms. Taleb's work explains this phenomenon through the concept of extremistan, which we will cover in depth later. These markets, where one person's sudden trade can influence millions of others instantly, are not governed by the gentle, predictable bell curve of normal data. They are governed by power laws where one small, random variable, like a viral Reddit post, can trigger an extreme, non-linear reaction. The FOMO, the fear of missing out, that drives these movements is the emotional consequence of living in a world defined by the black swan. We panic because we see others getting rich in an instant, and we know that the next wave of wealth creation will likely come from a place we cannot predict. 2. The crypto hype cycle and financial influencers. Bitcoin, Ethereum, and the thousands of altcoins that form the crypto market are, in a sense, a massive, ongoing, positive black swan event. Their entire value proposition relies on them being an outlier, a disruptive force that fundamentally changes the nature of money. But the price volatility, the sudden 50% crashes and 300% pumps, is a perfect illustration of Taleb's warnings about fat tails. In traditional finance, a huge price move is considered rare, residing in the tail of the bell curve. In crypto, the tail is fat. Extreme movements happen constantly. The vast majority of investors flock to the most vocal financial influencers, the gurus on TikTok and YouTube, who tell compelling, simple narratives about why the price moved. It was the institutional adoption. It was the new regulation. Taleb calls this a narrative fallacy. Our innate need to construct a believable story after the fact to soothe our confusion and make the randomness feel understandable. This is a fatal mistake. The actual reason is often far more complex, hidden, or purely random. 3. The Robinhood generation and leverage addiction. Platforms like Robinhood, which introduced zero-commission trading and gamified investing, lowered the friction to financial speculation to zero. This created a mass democratization of speculation, specifically in complex instruments like options. This rise in option gambling and cheap leverage has introduced enormous, hidden systemic fragility. Taleb argues that the biggest danger lies in hidden exposure to black swans. When millions of retail traders use cheap, easily accessible leverage and trade complex options, they are collectively taking on small amounts of highly concentrated, non-linear risk. No one trader thinks they're going to trigger a market event, but they are all exposed to the same sudden shock. The whole system becomes like a single, massive, leveraged position waiting for a sneeze to become a pandemic. Taleb would argue that this is a definition of fragile, a system that is exposed to massive damage from unexpected events. 4. The FIRE movement and the need for anti-fragility. The financial independence, retire early, FIRE, movement relies heavily on mathematical projections. Specifically, the 4% rule of withdrawal, which assumes a certain rate of return and market stability. This assumption of stability is exactly what the Black Swan demolishes. A fire-based portfolio, while prudent, is based on historical averages, Mediocristan thinking. What happens when a decade of zero returns or hyperinflation, a true Black Swan for retirement plan, comes along? The entire plan is invalidated. Taleb's philosophy moves beyond mere robustness, being able to withstand a shock, to anti-fragility, a concept he developed in a later book, but has foreshadowed here systems that benefit from chaos, volatility, and random error. The core lesson for the FIRE community is that your portfolio shouldn't just survive the next crash. It should be positioned to profit from it, or at least be so over-diversified and cash-rich that the chaos of the Black Swan event is merely an inconvenience, not a catastrophe. In essence, we are now living in a world that is moving rapidly from Mediocristan, the predictable world of averages where a Black Swan is irrelevant, to Extremistan, the volatile world of power laws, where a Black Swan is everything. Your success or failure in the next decade will be determined by whether you prepare for the average or prepare for the exception. This audiobook is your guide to preparing for the exception. It is your cinematic, deep dive into the mind of Nassim Nicholas Taleb, designed not just to inform you, but completely rewire how you view risk, history, and the future. Let's now explore the first foundational concepts of this revolutionary framework. We will break down the difference between the boring, predictable risks we obsess over and the catastrophic risks that actually define our lives. That's confirmed. Proceeding with the detailed breakdown, here is Chapter 1, The Feathered World of Mediocristan for the audiobook-style script. Chapter 1, The Feathered World of Mediocristan, The Lie of the Average. Welcome to Mediocristan. To truly understand the Black Swan, we must first explore the world where we think we live. Nassim Taleb calls this place Mediocristan. It is a comfortable, predictable domain of the average, the place where all the risks we obsessively model and measure actually reside. Mediocristan is governed by the principles of the Gaussian bell curve, the famous normal distribution. Think about human height, weight, or even the energy expenditure required to walk a mile. If you take 1,000 people, their measurements will cluster tightly around an average. The tallest person in the world will be maybe 3 times taller than the shortest, but not 1,000 times taller. The extreme examples, the outliers, are limited in their impact. If you stand 1 million people in a room and add the tallest person in the group, the average height barely shifts. The average is robust, and the extremes are negligible. This is a world of your high school statistics class, and is also the default setting for most traditional financial risk models. Fund managers, bankers, and even robo-advisors assume that market returns, stock volatility, and credit risk behave like this. They assume a crisis will be a 3 sigma event, an event so statistically rare that it should happen perhaps once every few thousand years. They look at the last 30 years of data, calculate the standard deviation, and believe they have successfully quantified their future risk. They live in Mediocristan. But modern finance, technology, wealth, and media are not governed by height or weight. They are governed by things that follow what Taleb calls Extremistan. In Extremistan, the bell curve is useless. Extremistan deals with things like net worth, book sales, social media followers, stock market returns, and the impact of viral video. In this domain, the distribution is not normal. It is governed by power laws. The extremes are everything. The richest person in the world is not twice as wealthy as the next person. They are tens of thousands of times wealthier than the average millionaire. If Jeff Bezos walks into that room of 1 million people, the average net worth instantly and fundamentally changes. One single outlier dominates the aggregate. The key insight that separates Mediocristan from Extremistan is what Taleb calls scalability. Non-scalable professions, Mediocristan, are those where your output is physically limited by your time and effort. A dentist, a plumber, a taxi driver. If they want to double their income, they must double their hours. Scalable professions, Extremistan, are those where your output is disconnected from your physical input. An author, a musician, a financial blogger, a coder. A single viral video or a single, highly leveraged trade can lead to geometrically increasing returns or, conversely, catastrophic losses. We, the investors, are operating our portfolios in a scalable, extremistan world defined by Black Swans, yet we are constantly advised and guided by models built for a non-scalable, Mediocristan world. This cognitive dissonance is the greatest risk in modern investing, the dangerous comfort of Platonism. Why do we cling so desperately to the beautiful lie of Mediocristan? The answer lies in the psychological flaw Taleb calls Platonism. Platonism, in this context, refers to our innate tendency to mistake the map of the territory, to prefer the clean, simple, and abstract model over the messy, complex, and uncertain reality. It is a fundamental human need to simplify the world down to manageable, neat concepts. We take the sprawling, chaotic market, boil it down to a few variables like P ratio or VIX, and then believe we have captured its essence. The problem with this financial Platonism is that it filters out the very things that matter, the outliers. Financial models based on the bell curve are Platonic models because they assume away the Black Swan. They assume that all relevant knowledge about the future is contained within the past data, and that any deviation from that past is minor and correctable. Think about a trading algorithm. It is an exquisite piece of engineering, but it operates entirely within the Platonic space of known variables. It can execute millions of trades in milliseconds based on historical volatility. But when the market experiences a true nonlinear shock, a sudden geopolitical crisis, or an unexpected change in Federal Reserve policy that no one modeled, the algorithm doesn't just fail, it often exacerbates the crisis. It relies on the market, following the script of the bell curve. When the market steps outside the lines, the algorithm, being purely Platonic, often goes into a feedback loop of panic selling, accelerating the shock. The lesson here is simple. Beware of experts who rely too heavily on models and classifications. When a financial analyst tells you, we are in an inflationary cycle, or this stock is definitely undervalued, they are imposing a clean, Platonic label onto a chaotic, non-Platonic reality. Reality doesn't care about their labels. The world is far messier and more unpredictable than any equation or model can capture, and the moment a model becomes too dominant, it becomes a point of systemic fragility. This intellectual arrogance is why people were so blindsided by the Bitcoin bubble cycles. Analysts continuously tried to impose traditional valuation models, cash flows, intrinsic utility, onto an asset that derives its value almost entirely from network effects, speculation, and narrative extremistan factors. They were trying to measure a whale using a yardstick designed for a minnow. The tyranny of the narrative fallacy. If the Black Swan is impossible to predict, why do we constantly believe we knew it was coming? This brings us to the second massive cognitive pitfall, the narrative fallacy. The narrative fallacy is our vulnerability to overinterpret events, to perceive patterns where none exist, and to reduce a confusing, complex world into a neat, digestible story. It is a survival mechanism that becomes a catastrophic flaw in finance. Consider the events of 2008. The moment the crisis hit, the financial media and experts immediately began to weave a comprehensive story. The subprime mortgage crisis was caused by greedy bankers, lax regulation, and the widespread use of toxic derivatives. While these facts are true, the story gave people a comfortable illusion that the event was predictable and avoidable. It allowed them to point fingers and say, we know exactly why this happened, so we can prevent the next one. Taleb argues that this narrative construction is retrospective. In reality, just weeks before the Lehman Brothers collapse, almost no one, not the central bankers, not the top hedge fund managers, not the financial journalists, was accurately predicting the full systemic collapse. This fallacy is amplified tenfold in the modern financial environment. Watch a financial news program after a major market move, a sudden drop in Tesla stock, or a massive jump in a sector ETF. The host will ask the expert, why did this happen today? And the expert will instantly provide a compelling narrative. Well, the market is reacting to X geopolitical event, combined with Y quarterly report and a general cooling of investor sentiment. The truth is, often, the market moved first, and the expert simply found the most plausible sounding reason after fact. The narrative comes to soothe the discomfort of randomness, connecting this to modern trading psychology. Crypto day trading. A beginner day trader might see Bitcoin drop 10% and immediately read 6 different articles, offering 6 different explanations. They latch onto the simplest one. It's whales manipulating the market because it gives them a story and an imaginary villain. This narrative makes them feel smart and in control, but it is pure noise. Performance review. Investment firms fall prey to this when they review a year of strong performance. Instead of acknowledging the role of luck, they create an elaborate, self-congratulatory narrative about their superior process, insight, and stock-picking ability. This narrative fallacy leads to overconfidence, a dangerous precursor to disaster, because they believe their carefully constructed story can predict the future, failing to recognize that their success might have been a positive black swan. The genius guru. Financial influencers thrive on the narrative fallacy. They don't just give you facts. They sell you a story, a step-by-step path to wealth, a secret system, a simple, controllable blueprint. This narrative is emotionally satisfying and creates trust, but it systematically hides a massive role of randomness and the impossibility of prediction. Taleb emphasizes that the desire for a narrative is rooted in biology. Our brains evolved to recognize simple cause and effect sequences to avoid predators. But in the highly complex, non-linear financial world, this instinct is a curse. To be a successful investor and extremistan, you must learn to accept confusion and to operate without the comfortable blanket of a neat, simple story. The silence of the evidence, the turkey problem. Perhaps the most visceral and human example of the Black Swan's deceptive nature is what Taleb calls the turkey problem. It illustrates the danger of drawing general conclusions from specific observations, particularly when those observations are limited. Imagine a turkey living happily on a farm. Every day, the farmer comes and feeds it. Day after day, the pattern repeats. Food, safety, comfort. If the turkey were a financial analyst, its data model would show a clear, beautiful, upward-sloping trend of goodwill and future expectation. The turkey's confidence in the farmer's benevolent intentions would increase with every passing day. Every sunrise confirms the existing hypothesis. The turkey uses the past as a perfect predictor of the future. But then comes day 1000, Thanksgiving Day. On that day, the farmer's actions are suddenly and catastrophically different. The turkey's entire data model is shattered in a single fatal moment. The event was a black swan for the turkey. The key takeaway is that the turkey was not just harmed by the black swan. Its own evidence was actively misleading it. The longer predictable pattern of feeding continued, the more certain the turkey became of its safety, and the greater the final shock. The evidence of the past was entirely irrelevant to the future. Modern investing reflection. The turkey problem today. This is the exact psychological trap millions of investors fall into in the modern era of cheap money and aggressive speculation. Zero commission trading and leverage addiction. Many young investors enter the market in the post-2008 low-interest rate environment. They have only ever seen a market where every dip is bought back quickly, where tech stocks perpetually ascend, and where leverage is easy and cheap. For many, a highly leveraged options position that worked well for 6 months provides evidence that they are a genius and that their strategy is flawless. They become the turkey, getting fatter and more confident with every successful leveraged trade. They assume the low volatility, perpetually rising market trend, the feeding, will continue indefinitely, increasing their exposure right before the inevitable, random, systemic shock, Thanksgiving. The Tesla and Bitcoin hype cycles. For years, both Tesla and Bitcoin defied traditional valuation. Every successful run confirmed the bullish narrative and attracted more turkeys. The longer the assets maintained their extreme valuations, the more certain believers became that the old rules no longer applied. They took on more leverage, used margin, and dismissed all warnings as outdated. The inevitable massive pullbacks, which have happened multiple times, are black swans to the highly leveraged investor who have become accustomed to the steady feeding. ETF dominance. The move toward passive investing via massive ETFs is generally a prudent strategy, but also creates a systemic turkey problem. As more money flows into a handful of index tracking funds, the prices of the largest stocks within those indexes are mechanically pushed up regardless of fundamentals. The longer this trend continues, the more certain people become that index investing is the only way. This creates a hidden fragility. When a shock eventually hits, the massive, highly concentrated pool of capital in those index funds will all try to exit at the same time, accelerating decline in an unprecedented way. The positive trend is the feeding. The mass exit is the Black Swan. The lesson from the turkey is not to avoid risk, but to recognize that past stability is not a guarantor of future stability. In fact, the longer a period of unexpected stability lasts, the greater the potential Black Swan event that will eventually break the trend. The Black Swan always hits where confidence is highest. We must therefore acknowledge that all our careful models, all our backtests, and all our projections are built on the naive assumption that the world is Mediocristan. To survive, we need to learn how to live in Extremistan, which means accepting a radical new approach to knowledge, prediction, and risk-taking. Chapter 2, The Domain of the Extremes. The fatal flaw of the bell curve. We have established that the most significant forces in our modern world, financial assets, technology valuations, viral success, do not live in Mediocristan, the land of averages. They live in Extremistan, the domain of the wild, unpredictable, and nonlinear. The instrument of deception that allows us to pretend otherwise is the Gaussian bell curve. The bell curve, or normal distribution, is elegant, it is simple, it is mathematically convenient. And in the world of finance, it is a catastrophic lie. The bell curve assumes that extreme deviations, the events that are many standard deviations away from the mean, are almost impossible. In a truly normal distribution, an event that is 5 standard deviations away is so rare that it should occur less than once in several million years. This means that a stock market crash of, say, 15% in a single day should be an event of geological rarity. Yet we know this is false. The stock market, and virtually every modern leveraged financial instrument, experiences these impossible events with alarming regularity. The 1987 crash, the 2000 tech bubble burst, the 2008 meltdown, the flash crash of 2010, the COVID-19 panic of 2020. These events were all mathematically impossible, according to the standard Platonic models used by virtually every major bank, hedge fund, and regulator. They were events residing in the fat tails. Taleb's point is devastatingly simple. The bell curve underestimates the probability of extremes and overestimates the probability of mediocrity. It compresses the risk distribution, making the world seem safer and more predictable than it actually is. The tail of the distribution in Extremistan is not thin and tapering to zero, as the bell curve suggests. It is fat. It means that events previously classified as Black Swans, the rare outliers, actually occur with far greater frequency than our standard models dare to admit. In a fat tail distribution, one single day of trading can account for a significant percentage of the entire year's volatility and movement. One single stock, like Tesla, can dominate the attention and capital of millions of investors for years, making its volatility a systemic risk, not an isolated one. If you rely on a model that assumes a thin tail, and you invest in a market that actually has a fat tail, you are structurally and systematically underinsured. You are trading with a hidden, massive exposure to Black Swans that your own risk management system tells you is virtually zero. This is a definition of financial delusion, the illusion of expert knowledge, the epistemocracy. If we cannot predict the future using mathematical models, can we rely on human expertise? Taleb's answer is a resounding no, particularly in fields defined by Extremistan, which he calls epistemocracy, the rule of those who claim to know. Taleb draws a crucial distinction between 2 types of knowledge or expertise. Mediocristan experts. These experts operate in predictable environments where the next event is not a Black Swan. Think of a dentist, a chef, or a bridge engineer. They use repeatable methods, and the environment is constrained. Their predictions are generally reliable because the probability distribution of outcomes is thin-tailed. Extremistan experts. These experts operate in scalable, complex environments where the next event will be a Black Swan. Think of stock market forecasters, geopolitical strategists, or economic commentators. Their predictions are largely worthless, but they are highly paid and respected because of the narrative fallacy. They provide a soothing story. Taleb cites studies showing that the accuracy of professional financial and political forecasters is often no better than random chance, or even slightly worse than a dart-throwing monkey. Why? because they are constantly confusing the two worlds. They attempt to use the predictable methods of Mediocristan, like trend lines, P/E ratio analysis, or historical volatility, to predict outcomes in Extremistan, the scandal of prediction in the digital age. The problem has been amplified by the rise of financial TikTok and YouTube gurus. These individuals, often without formal training or skin in the game, gain enormous followings by offering confident, simple predictions. Bitcoin is going $100,000 by year-end because the chart looks like X. Sell all your growth stocks. The macro environment has shifted to Y. These confident forecasts are dangerous for two reasons. They feed the narrative fallacy. They give a listener a simple, actionable story, relieving them of the burden of complexity and uncertainty. They have zero accountability. Unlike a bridge engineer whose mistakes become physically obvious, the predictions of financial guru are quickly forgotten after the event or subtly altered into a new narrative. They get paid for the confidence of their prediction, not its accuracy. Taleb's ultimate critique of the epistemocracy is about skin in the game. The expert who makes bold claims but suffers no personal financial or professional consequence when those claims fail is inherently dangerous. If a high-level bank economist incorrectly predicts inflation for 3 consecutive years, does he lose his job? Usually not. But the millions of investors who followed his advice bear the full financial cost. The experts are protected from the Black Swan consequences they create for others. The problem of induction and the confirmation trap. The turkey problem is a specific example of a deeper philosophical flaw known as the problem of induction. This problem, famously explored by the philosopher David Hume, asks, can the future be reliably known by observing the past? Every time we make a prediction based on historical data, we are engaging in induction. We assume that because the sun has risen every day for our entire lives, it will rise tomorrow. This is a reasonable assumption in Mediocristan, but it is fatal in Extremistan. The flaw is that no amount of observed evidence can ever definitively prove a universal positive statement. Observing 1,000,000 white swans does not prove that all swans are white. It only takes a single black swan observation to disprove the entire theory. In finance, this translates to the confirmation trap. Dollar cost averaging, DCA, in a bubble. DCA is a rational strategy for long-term investors. But during periods like the late 1990s tech bubble or the 2020 to 2021 crypto boom, investors engage in DCA into hugely speculative assets. The market's continuous rise confirmed their strategy daily. See? Every time I buy, it goes up. I'm right. Every successful buy provided strong, deceptive evidence of a rising trend, making the eventual crash, the Black Swan, even more painful because their confidence was at its absolute peak. They confuse a long-term strategy, DCA, with a belief in perpetual market momentum. The zero-commission brokerage model. The entire model relies on users successfully executing trades that confirm their confidence. The more they win, the more they trade, and the more revenue the platform generates. The system is designed to reward short-term success and confirmation bias, pushing users toward higher leverage and more speculative bets, ignoring the looming, unquantifiable risk of a systemic failure. The lesson is that in Extremistan, we must be intellectually humble. We must approach the market not asking, what will happen next, but what is the most catastrophic thing that could happen that my model doesn't account for? How digital markets amplify greed and fear. The fundamental nonlinearity of the Black Swan event is not just a statistical fact. It is a psychological one, and the digital market structure amplifies the psychology into dangerous feedback loops. Taleb's critique of the human tendency toward greed and fear is directly applicable to the modern, hyper-connected market. Amplified greed, the positive Black Swan hunt. The digital economy has created an unparalleled environment for positive Black Swans, those rare, massive success stories like Google, Amazon, or Bitcoin. Because the rewards are so enormous, 100x, 1000x returns, millions of individuals are incentivized to engage in hyper-speculative behavior, essentially gambling to catch the next outlier. This hunt for the next positive Black Swan fuels the meme stock manipulation cycle. When a few key influencers or decentralized groups coordinate, they are trying to force a Black Swan. They know the nonlinear returns are in the extreme, not the average. This pursuit, while exciting, introduces massive fragility into the system because it relies on the greater fool theory and an immediate, non-fundamental narrative. The vast majority who join in are simply setting themselves up for the inevitable return to Mediocristan. Amplified fear, social media panic cycles. The speed of social media ensures that fear spreads faster than information. When a financial shock hits, a major bank failure, an unexpected inflation spike, or even a simple rumor, it does not follow a normal, slow-moving transmission line. It becomes a viral contagion. Taleb would argue that the modern market structure creates cascading nonlinear responses. A rumor hits Twitter. It is instantly picked up by algorithmic funds. Those algorithms trigger selling. The selling triggers margin calls on retail traders. The margin calls force more selling, and the entire market dips violently. This entire cycle is a purely human reaction to uncertainty, magnified by technology. The speed of the response makes the event a mini Black Swan in its rapid, unexpected, and systemic impact. The ability to trade 24/7, the instantaneous connection with financial influencers, and the gamified nature of trading apps all contribute to collective, systemic overreaction to both positive and negative outliers. The market has been psychologically wired to live on the edge of Extremistan, increasing the frequency and destructive power of the Black Swan events experiences. Modern investing reflection, passive versus hyperspeculative behavior. The tension between the long-term passive investing philosophy, like index funds and fire-based asset allocation, and the short-term hyperspeculative behavior, like option gambling and day trading psychology in the 2020s, is the ultimate battleground of Mediocristan versus Extremistan. The passive investor's Black Swan. The passive investor, while generally safe, is still susceptible to the turkey problem of prolonged bull markets. Their biggest risk is a prolonged, decades-long economic stagnation, a massive global inflation wave, or a collapse in the very index they track. These risks are low probability but high impact, and the only defense is Taleb's concept of anti-fragility, having a sufficient buffer cash in genuinely uncorrelated assets to benefit from the chaos, rather than just surviving it. The hyperspeculator's daily grind. The hyperspeculator is hunting for Black Swans every day. They are essentially selling stability and buying exposure to tail risks. The danger for them is a ludic fallacy, which we will cover more in the next chapter, and the certainty that they will eventually be hit by a negative Black Swan that wipes out all their smaller, accumulated gains. Trading highly leveraged options is akin to picking up pennies in front of a steamroller. The expected small return is not worth the risk of the inevitable, non-linear catastrophe. The critical lesson from Taleb here is that you must choose your domain and adjust your tolerance. If you're going to be a long-term investor, you must accept that you are betting on the stability of the system, and therefore you must be prepared for the system's eventual, temporary collapse. If you're going to speculate, you must use money you are truly willing to lose and avoid the deadly combination of leverage and overconfidence. We must now turn our attention from the diagnosis of the Black Swan to the practical, philosophical implications of living in a world of extremes, and how our minds construct reality to deal with the unbearable power of randomness. We have now established the statistical fraud of the bell curve and the psychological trap of the financial expert. The next major section, Chapter 3, the scandal of prediction, will focus on the practical inability to predict, the cognitive biases that blind us, and how we can structurally immunize ourselves against Black Swans. That is approved. We move now to the core philosophical and practical critique of predictability itself. Here is Chapter 3, the scandal of prediction for the audiobook-style script. Stop sign Chapter 3, the scandal of prediction, the fatal confusion, the ludic fallacy. The inability to predict Black Swans is not merely a technical limitation. It is a profound philosophical trap cemented by our reliance on contrived, laboratory-style examples of randomness. Taleb calls this trap the ludic fallacy, a term derived from the Latin word ludus, meaning game. The ludic fallacy is a mistake of confusing the randomness found in games of chance, like dice rolls, coin flips, or casino roulette, with the randomness found in real life. In games, the rules are known, the outcomes are finite, and the probabilities can be precisely calculated. A die has 6 sides, and the odds of rolling a 6 are always 1 in 6. This is clean randomness. In the real world, and especially in finance and geopolitics, the randomness is dirty. We do not know the full list of sides a die might land on, and new, unforeseen sides can emerge at any moment. The invention of the internet, the sudden global adoption of the iPhone, or the emergence of a zero-day virus that shuts down global markets are all sides of the real-world die that were not in the original model. The danger of the ludic fallacy is most evident in the world of algorithmic trading and quantitative strategies, quants. These highly sophisticated financial systems are built on complex mathematical models that assume they know all the relevant variables and probabilities. They take historical data and treat it like the results of a million simulated dice rolls, calculating the risk of various outcomes. But the real market is not a casino. The market is not a closed system. When a quant uses a value-at-risk VAR model, they're essentially asking, based on the last 5 years of market data, what is the maximum amount we could lose with 99% probability? This is a purely ludic calculation. It assumes the next 5 years will be mathematically similar to the last 5 years. What it fails to account for is the unknown unknown, the Black Swan event that changes the rules of the game entirely. The moment a new technology disrupts an industry, e.g., streaming killing physical media, or a regulatory shock changes capital requirements, the fundamental probabilities shift, and the quant model becomes instantly worthless. The model fails not because its calculations were wrong, but because its assumptions about the structure of reality, that it is a game with fixed rules, were fatally flawed. Connecting to option gambling. The ludic fallacy is the invisible hand driving much of the option gambling prevalent today. Options are complex, leveraged instruments based on the expected future volatility of an underlying asset. The pricing of an option often relies on Platonic model, like the Black Swans model, which assumes that volatility is normally distributed and constant. Retail traders engaged in option gambling, particularly short-term zero-day options, are essentially betting on a small, predictable range of outcomes. They are playing a game with dice, assuming the market will behave according to the textbook probabilities. When the market experiences a sudden random surge or crash, a move that is a statistical non-event according to the model but happens due to real-world human panic, extremistan factors, the highly leveraged option position is wiped out instantly. The gambler confused the elegant math of the options pricing model, the ludic world, with the messy, non-linear reality of the market, the extremistan world. The lesson is to be suspicious of any complex financial product whose risk profile depends on a neat mathematical model. The more beautiful the math, the more dangerous the hidden, unquantified risks. The compounding error and retrospective distortion. Taleb argues that our ability to predict is not just bad. It actively gets worse the further out we attempt to look, and yet our confidence often increases. This is the scandal of prediction. In complex systems, prediction errors are not linear. They compound. Imagine predicting the path of a bouncing ball. The initial error in measuring the starting velocity or angle will multiply with every bounce, making a long-term prediction wildly inaccurate. The global financial system, with its millions of interconnected transactions, is an infinitely more complex bouncing ball, the illusion of historical inevitability. After a major Black Swan, our mind suffers from retrospective distortion, a key component of the narrative fallacy. We look back and say, of course the internet was going to dominate global communication, or it was inevitable that the housing bubble would burst. Taleb calls this the "I told you so" phenomenon. The event, once it happens, seems inevitable and thus retrospectively predictable. We delete the thousands of equally plausible alternative histories that didn't occur. Example, Tesla hype and retrospective justification. If you had predicted in 2012 that a niche electric car company would become one of the most valuable companies in the world by 2020, people would have dismissed you. Yet, now that it has happened, millions of analysts and financial commentators offer intricate, logical, step-by-step narratives explaining why the rise was inevitable. The brilliance of Elon Musk, the shift to EVs, the cult-like following. This narrative is a comfortable lie. The reality is that the path was fraught with near bankruptcies, production hell, and massive, random market volatility. The success was a string of positive Black Swans that, in retrospect, look like destiny. This distortion is fatal to learning because it teaches us the wrong lesson. If we convince ourselves that the past was predictable, We continue to believe the future is predictable, and we fail to prepare for the truly unexpected. The historian or the commentator creates a false sense of security, ensuring that the next Black Swan will hit us just as hard as the last. We must train ourselves to recognize that history is opaque to the future, but transparent to the past. The past looks smooth and logical only because we have filtered out the chaos. The problem of passive versus active risk exposure. Taleb's philosophy forces us to critically reevaluate the two major modern investment camps: passive index investing and active, speculative trading. 1. Passive investing, the risk of the crowd. ETF dominance is a perfect embodiment of systemic risk under the veil of security. An index fund is designed to minimize exposure to individual, idiosyncratic risks like one company failing. This is good. However, by concentrating the vast majority of global capital into a handful of identical indices, investors are creating a single, massive point of failure, a collective, systemic fragility. When a massive, unexpected crisis hits, like a global inflation wave or an unforeseen liquidity crunch, it will not cause one company to fail. It will cause a simultaneous, indiscriminate panic across the entire index. Because the buying and selling of these funds are often dictated by programmatic, unthinking rules, the selling pressure during a panic will be nonlinear and self-reinforcing. Passive investors, seeking safety and diversification, have actually diversified into a highly correlated, systemic exposure to the next negative Black Swan. Their only advantage is time and patience. 2. Active speculation, the leverage addiction. The active side, fueled by cheap leverage and the instantaneous feedback of social media, is engaged in a constant, high-stakes game of prediction, despite its impossibility. Leverage addiction is the Black Swan amplifier. Leverage is borrowing money to amplify returns. It turns Mediocristan risks into Extremistan risks. If you buy a stock without leverage, you can lose 100% of your money. This is a finite, predictable risk Mediocristan. If you buy a stock with 10x leverage, a 10% move against you can wipe out 100% of your capital, often instantly via margin call. This transforms a normal market fluctuation into a sudden, catastrophic Black Swan for your account. Taleb views leverage as a form of selling optionality. You gain a small, steady return in normal times, but you are exposed to a nonlinear, unlimited loss in extreme times. You are giving away the right to survive the Black Swan. Leverage ensures that when a Black Swan hits the market, it doesn't just hurt you, it liquidates you. It eliminates your ability to recover and participate in the eventual bounce. This highlights a key principle: never expose yourself to ruin. Regardless of potential upside, if a single, unforeseen event can take you out of the game, your strategy is fragile and unsustainable in the long run. The path to immunization, the asymmetry of serendipity. If prediction is impossible, what is the alternative? The solution is not to become a pessimist who avoids all risk, but to become an anti-fragile thinker, one who structures their life and portfolio to benefit from the disorder and chaos that Black Swans create. The way to immunize oneself against negative Black Swans is to ensure an asymmetry of outcome, a concept often termed convexity or optionality. This means seeking situations where the potential downside is limited and known, like a small, defined premium. The potential upside is unlimited and open-ended, like a massive, unforeseen Black Swan payoff. This is the principle of a barbell strategy. 90% safety. The stability put the vast majority of your capital, say 80 to 90%, into extremely safe, boring, Mediocristan investments, cash, short-term treasury bills, or broadly diversified, low-fee index funds. The goal here is not massive returns, but survival and preservation during crisis. This side protects you from the negative Black Swan. 10% speculation, the optionality to take a small, clearly defined portion of your capital, say 10 to 20%, and use it for highly speculative, high-upside ventures. This could be early-stage venture capital, a basket of highly volatile microcap stocks, or even crypto assets. Crucially, this must be money you can afford to lose 100% of. The goal here is not to predict the next big thing, but to simply have a low-cost ticket to the massive, non-linear payoff of a positive Black Swan. In this barbell approach, you're insulated from a negative shock because 90% of your wealth is safe. And you are structurally positioned to benefit from a positive shock because that small, speculative 10% can deliver 100x or 1000x returns, overwhelming the modest gains of your safe portfolio. You are no longer playing the game of predicting the improbable. You are playing the game of exposure management. You are creating a strategy where the worst-case scenario is manageable and the best-case scenario is limitless. Modern investing reflection, the antidote to social media panic. The application of this convexity principle is the only true defense against the social media financial panic cycles we see today. The panic cycles, the sudden, coordinated selling on a rumor, followed by the frenzied buy on a piece of good news, are the essence of extremistan volatility. The average investor, operating with a conventional portfolio, is fragile to this cycle. They panic and sell low during the fear-driven dip, negative Black Swan exposure. They buy back and late during the FOMO-driven peak, missing the positive Black Swan exposure. The barbell approach flips this fragility into anti-fragility. Emotional discipline. Because 90% of your wealth is in safe, boring assets, you're emotionally immune to the daily chaos on financial TikTok. You can watch the panic unfold without feeling compelled to sell your safe assets, maintaining your long-term calmness. Strategic opportunity. When a true, massive panic hits, a negative Black Swan like the 2020 COVID crash, your safe cash and conservative portfolio provide the stability needed to act. This is where the anti-fragile investor steps in. Chaos is not a threat. It is a discounting opportunity. They can buy assets at fire sale prices precisely when a fragile, over-leveraged, and panic-driven market is forced to sell. Taleb is telling us that success in Extremistan is not about being smart enough to predict the future. It is about being wise enough to structure your life so that you are rarely harmed by disorder and often benefit from it. It is a philosophical, structural defense, not a predictive one. We have explored the impossibility of prediction and the traps of the ludic fallacy and leverage. The final major chapter will now synthesize these ideas, exploring the role of chance, the ethics of risk, and how to harness positive Black Swans through a mindset of intelligent optionality. That is approved. We are now entering the final major breakdown of the book, focusing on the human response to chaos and the practical application of Taleb's philosophy. Here is Chapter 4, From Stoicism to Serendipity for the audiobook-style script. Lightbulb Chapter 4, From Stoicism to Serendipity, the Ethics of Knowledge and the Role of Luck. Throughout his work, Nassim Taleb champions the idea of intellectual honesty regarding the role of luck. In a world defined by Extremistan and Black Swans, luck is not a marginal factor. It is the dominant force behind extreme success and catastrophic failure. Yet, our society, our financial culture, and our individual egos are built on a denial of this randomness. Taleb introduces the idea that we must cultivate a stoic attitude toward the outcomes we cannot control. Stoicism, an ancient philosophy, teaches us to differentiate between what is within our power, our effort, our actions, our preparation, and what is outside of it, the ultimate result, the random shock, the Black Swan. When a successful investor is interviewed, they invariably discuss their strategy, their diligence, and their research. They construct a compelling, retrospective narrative of competence. While competence is necessary, Taleb argues it is rarely sufficient to explain outlier success. For someone to achieve massive, scalable wealth, the kind of wealth generated by catching a positive Black Swan, like an early investment in Google or Bitcoin, they require not just skill, but an enormous, non-linear dose of luck. The danger in denying luck is that it leads to arrogance and a false sense of security, particularly among those who have only known success during a prolonged bull market. This is where the FIRE movement and long-term financial planning often stumble. A plan designed around a 7% average annual return assumes a level of predictable competence, but a single massive crash, a negative Black Swan, can wipe out years of accumulated gains, demonstrating the power of the random shock. Conversely, a single brilliant investment made early in life, a positive Black Swan, can catapult one to financial independence far faster than any predictable spreadsheet ever suggested. The philosophical pivot, therefore, is to focus relentlessly on process rather than outcomes. You cannot control whether a Black Swan hits, but you can control your exposure to it. Did you take on excessive, ruinous leverage? That was a bad process, regardless of the short-term outcome. Did you structure your portfolio so that if you are wrong, you lose a little, but if you are right, you gain massively? That is a good process, regardless of whether the Black Swan hits tomorrow or a decade from now. Taleb's ethics demand skin in the game, that those who make predictions or manage risk should suffer the consequences of their failures. This ethical constraint forces honesty and humility, combating the epistemic arrogance that defines the expert class. Navigating the waters of chance, the two Black Swans. Not all Black Swans are negative. Taleb makes a critical distinction that guides the entire practical application of his philosophy. The world is divided into domains where we are exposed to either massive negative shocks or open to massive positive shocks. We must become paranoid about negative Black Swans and greedy about positive Black Swans. 1. Avoiding the negative Black Swan, the domain of hidden ruin. Negative Black Swans typically reside in areas where interconnectedness, leverage, and hidden concentration exist. These are the areas where the risk of ruin is present and unquantifiable. Cheap leverage through technology. The ease with which the average investor can now access margin, credit card debt, or complex leverage derivatives means that a simple market correction can become a life-changing financial disaster. You are constantly selling the highly valuable option to survive in exchange for tiny leverage returns. The systemic risk of zero-commission trading. The platforms that allow free trading encourage massive volume and fast, emotional decision-making. The individual cost of a trade is zero, but the systemic cost of a mass, simultaneous panic enabled by these frictionless platforms is astronomical. When the next market-wide negative Black Swan hits, the sheer volume of forced selling from highly concentrated, algorithmically driven retail positions will likely exacerbate the depth and speed of the crash far beyond historical norms. The core survival principle is maximum conservative exposure. Do everything you can to remove the possibility of complete ruin. This means no excessive leverage, enough cash buffer to survive prolonged periods of unexpected job loss or market stagnation, and avoiding any exposure where the downside is unlimited. 2. Harnessing the positive Black Swan, the domain of serendipity. Positive Black Swans are the major inventions, discoveries, and breakthroughs that create new wealth. The sudden viral success, the unexpected scientific leap, the massive return on an early-stage investment. These reside in the scalable professions and assets, Bitcoin bubbles and crypto casinos. While the volatility of crypto is terrifying, it is the ultimate example of a positive Black Swan hunt. Its returns are purely scalable and nonlinear. The intelligent investor doesn't try to predict the next Bitcoin. They allocate a small, sacrificial portion of their portfolio, the 10% in the barbell strategy, to a highly diversified basket of these highly volatile, non-correlated assets. They are buying optionality, a cheap call option on massive future disruption. The most important thing is not predicting which one will succeed, but ensuring you have exposure to the possibility of any one of them succeeding. Fractional shares culture. This modern innovation actually aids a Black Swan hunter. It allows an investor to buy small pieces of many different high-potential, high-volatility assets that might otherwise be unaffordable. Instead of betting $500 on one hyper-risky stock, you can bet $50 across 10, increasing your probabilistic exposure to the eventual positive outlier. The key is to create an environment where the nonlinear returns are yours to capture. Maximize your exposure to positive randomness, while minimizing your exposure to negative randomness. The barbell strategy, the anti-fragile investor. We have introduced the concept of the barbell strategy, and now we must delve into its operational philosophy, which is the ultimate takeaway from Taleb's work. The barbell is not just an asset allocation strategy. It is a way of life designed for extremistan. The stable core, 90% the stoic anchor. This large, safe portion of the portfolio serves a purely defensive purpose to ensure survival. Focus on capital preservation. This involves cash, inflation index bonds, or ultra-low-cost, broad market index funds. The goal is to avoid the negative tail risks that wipe out wealth. Emphasizing calmness. This anchor provides the psychological capital necessary to navigate market volatility. When the market is crashing due to a financial panic, the investor can look at their large, safe core and maintain the emotional discipline to do nothing, which is often the best action. The noise of financial tick-tock and the panic of the media cannot break the stoic calmness provided by the knowledge of guaranteed survival. The speculative edge, 10% the serendipitous option. This small, independent portion of the portfolio is the hunting ground for the positive Black Swan. Hyper-speculative behavior. This is where option gambling, used selectively for cheap, long-dated calls on market volatility, venture investments, or early-stage crypto exposure belong. The risk of ruin in this small bucket is 100%, but the potential reward is 10,000%. The non-correlation thesis. The 10% should be invested in assets that are not correlated with the 90% bucket. If the stock market crashes, the 90% is safe, and the 10% might include assets that benefit from chaos, like volatility funds or assets that thrive outside the traditional financial system. This lack of correlation is the essence of true diversification in Extremistan. The genius of the barbell strategy is that it rejects the false safety of the middle ground. The middle ground, the moderate, diversified portfolio with small amount of leverage, is precisely where Black Swans do the most damage. It is neither safe enough to survive the crash, nor speculative enough to capture the enormous gains. The barbell separates the world into the safe and the hyper-risky, minimizing the exposure to the dangerous mediocrity in between. The view from the future. Taleb's scrutiny of modern finance. Imagine Nassim Taleb observing the current financial landscape. What would he say about the new technologies and trends that have emerged since his book's publication? 1. AI-driven hedge funds and algorithmic trading. Taleb would see these high-speed, hyper-complex systems as the ultimate embodiment of Platonic risk and the ludic fallacy. His likely quote, "The smarter the algorithm, the stupider the collective outcome." The critique, AI funds are exquisite machines for optimizing returns under normal conditions. They backtest perfectly because they are trained on past data, the turkey's feeding schedule. But their complexity makes them a black box. No one truly understands the millions of lines of code. When a truly unprecedented event occurs, a black swan that is statistically impossible according to their model, all these powerful, complex algorithms will likely do the same thing at the same millisecond. Panic sell. This creates a massive systemic flash crash, a man-made black swan that originates not from outside, but from the elegant Platonic risk models themselves. The illusion of perfect knowledge makes the system hyperfragile. 2. Financial TikTok and YouTube gurus. Taleb would view these platforms as the perfect engine for narrative fallacy and the confirmation trap. His likely quote, "They are selling a simplified map to a complex territory they have never explored themselves, and their skin is not in your game." The critique, these gurus thrive on confidence, not accuracy. They propagate simple, high-impact stories that soothe the investor confusion and make randomness feel controllable. They create herd behavior, directing millions of retail traders toward the same few, highly volatile assets. This collective action is highly fragile. When the coordinated movement breaks, the resulting loss, the negative black swan for the retail herd, is devastating, while the guru simply moves on to the next narrative. 3. Crypto casinos, NFTs, and speculation. He would see these sectors as pure Extremistan, an environment for intellectual optionality and philosophical study. His likely quote, "The only way to play in a casino is with chips you are willing to lose, knowing you are hunting a unicorn." The critique, he would applaud the decentralized, anti-establishment, black swan nature of the assets themselves, the positive optionality. But he would condemn the massive leverage, the hypercorrelation, and the herd mentality of retail investors who bet their rent money. The key lesson here is not to avoid the crypto casino, but to recognize it for what it is, a hunting ground for the 1,000x positive black swan. It must be treated with a small, clearly defined, sacrificial capital of the barbell's 10% edge. Modern investing reflection, the timeless power of patience. The entire philosophy of the black swan converges on one timeless investment virtue: patience. If you accept that the most important events are impossible to predict, then frenetic activity, constant trading, daily portfolio checking, and trying to time the next shock is not just useless, it is counterproductive. The only way to capture the gains from a positive black swan is to be in the game and survive long enough for it to happen. If you are constantly leveraged, a negative black swan will take you out of the game before the positive one can occur. If you are constantly trading based on narratives, you are likely to be shaken out of your position right before the nonlinear returns begin. The anti-fragile investor, operating the barbell strategy, practices a form of financial stoic patience. They are comfortable being bored. They know that the 90% is safe, and the 10% is their lottery ticket. They do not need daily dopamine hits from trading. They are simply waiting for the inevitable disorder, the Black Swan, to create their opportunity. Whether that opportunity is a crash that allows them to buy safe assets cheaply, or the explosion of a speculative asset that makes their small bet enormous, they are positioned to benefit from volatility, not suffer from it. The power of this mindset is immense. It transforms the investor from a fragile, panic participant who needs to know the future into an anti-fragile, patient opportunist who benefits from the fact that no one knows the future. We have completed the chapter-by-chapter breakdown of the core philosophy. We have understood the distinction between predictability and chaos, and the structural steps required to navigate extremistan. If Nassim Nicholas Taleb were to observe the current financial landscape, the markets of the 2020s, dominated by ubiquitous technology, ultra-cheap leverage, and instantaneous social media propagation, he would not be surprised. He would be vindicated, perhaps even alarmed by the hyperfragility he would see. He predicted that the very tools used to manage complexity would, through their Platonic arrogance and systemic concentration, inevitably amplify the next Black Swan. 1. The paradox of AI-driven hedge funds and quant strategies. The modern financial market is increasingly managed not by humans, but by algorithmic trading and sophisticated AI-driven hedge funds. These systems, running on machine learning models, are designed to find tiny, fleeting inefficiencies in the market and execute millions of trades faster than human thought. Taleb would see these entities as the ultimate expression of the ludic fallacy and the turkey problem. The AI is built using vast pools of historical data, learning patterns and correlations that held true for the past decade, a period largely characterized by low inflation and quantitative easing. The AI is the perfect turkey. It is absolutely confident in its predictions because its training data, the farmer's continuous feeding, shows continuous success. It believes the environment is stationary and predictable, Mediocristan. But the AI is fundamentally blind to the unknown unknowns. Asterisk model risk concentration, asterisk, every single AI and quant strategy tend to hunt for the same correlations. They use similar variables, similar risk models, which are all based on a bell curve lie, and similar execution strategies. This leads to model risk concentration. When a true unprecedented Black Swan hits, a sudden global inflation wave driven by unprecedented fiscal spending, or a geopolitical shock that fundamentally breaks a major supply chain, the signal that causes one algorithm to sell will cause all the algorithms to sell at the same microsecond. Asterisk the flash crash amplification, asterisk the sheer speed of execution, means that the market no longer has a natural human friction. The slow thinking, the hesitant trading, that used to act as a natural brake. When an unexpected event triggers panic, the algorithms execute a massive, non-linear selling sequence that turns a normal 5% dip into a 20% flash crash. Taleb would argue that the quants have injected dangerous speed and correlation into the system, ensuring that when the next shock comes, it will not be a ripple, but a systemic wave of instantaneous liquidation. Their mathematical beauty conceals the fragility of the entire edifice. 2. The illusion of control, robo-advisors and fractional shares culture. The democratization of investing through robo-advisors and the ease of buying fractional shares seems, on the surface, to be a positive development, making investing accessible. Taleb would caution that this ease of access can create systemic risk through uniformity and hidden leverage. Asterisk the robo-advisor uniformity, asterisk robo. Advisors often rely on modern portfolio theory, MPT, which assumes returns are normally distributed and risks can be managed through correlation matrices, a very Platonic, Mediocristan view of the world. While suitable for basic diversification, if every robo-advised portfolio across the globe is following the same MPT optimization logic, they're all implicitly making the same bets and all exposed to the same sudden systemic shock. Their collective, programmed response to a Black Swan will be uniform, predictable, and amplifying. Asterisk the fractional share trap, asterisk. While fractional shares aid the barbell strategy by allowing small, diversified optionality, the culture surrounding them often leads to overconcentration in a few highly volatile names, e.g., fractional ownership of Tesla or Nvidia. People confuse affordability with safety. They feel safe buying $$$10 stock, not realizing that when millions of fractional share owners are all in the same few speculative names, they have collectively created a massive, correlated risk pool vulnerable to a sudden narrative-breaking sell-off. The low barrier to entry facilitates widespread participation in speculative Black Swan hunts, leading to greater human and systemic losses when the hunt fails. The financial gurus and the manufacturing of certainty. Taleb's most scathing critique would be reserved for the ecosystem of digital financial communicators, the financial TikTok and YouTube gurus, who have monetized the narrative fallacy and the public's desperate need for certainty. 1. The selling of simple narratives. These influencers thrive because they reject complexity, which Taleb argues is the necessary condition for reality. The human mind prefers the simple, the clear, the actionable, asterisk the story versus the uncertainty asterisk instead of saying, the market is a complex, non-linear system where outcomes are dominated by unpredictable black swans. The guru says, follow these 3 simple steps to financial freedom, or buy this one crypto based on this chart pattern. They provide an intellectually soothing narrative that replaces the actual, frightening uncertainty. Asterisk meme stock manipulation, asterisk the coordinated efforts on platforms to pump a stock are a modern manifestation of the narrative fallacy turning into a collective, leveraged trade. They create a story, e.g., we are fighting the hedge funds, that is emotionally compelling and simple, overriding all logical or fundamental analysis. The participants are not investing. They are participating in a collective positive Black Swan hunt driven entirely by a fabricated narrative. The resulting volatility and subsequent collapse are devastating Black Swans for the retail participants who bought into the story late. 2. The crypto casino and NFT madness. Taleb would see the recent explosions of NFT madness and the wider crypto casino as the purest, most transparent form of extremist speculation. Asterisk nonlinearity without fundamentals asterisk NFTs, and many altcoins derive their value entirely from network effects, virality, and collective belief. Purely scalable, nonlinear, extremist factors. They are the ultimate financial manifestation of positive Black Swans. However, the vast majority of these assets will inevitably collapse to zero. Asterisk amplify greed and fear asterisk the instantaneous, 24/7 nature of crypto trading, combined with the social media amplification, creates a market that runs on maximum greed FOMO and maximum fear panic selling. It is a system designed to exploit the human preference for story and urgency, making investors highly vulnerable to sudden, negative price shocks that are endemic to fat-tailed distributions. Taleb's barbell strategy is the only defense, a small, sacrificial allocation to capture the upside, surrounded by a massive core stability to ensure the inevitable crashes do not cause ruin. The central theme connecting many of these modern flaws is the availability of cheap leverage through technology. Leverage is the antithesis of the Black Swan mindset. The Black Swan thinker knows that extreme events happen more often than mathematically predicted. The leveraged investor bets that they won't happen. Taleb would point out that the global financial system is now permeated by leverage that is invisible to the casual investor. Asterisk repo markets and central banks asterisk the massive amount of liquidity injected by central banks after every crisis creates the illusion of permanent stability and provides cheap, systemic leverage. This makes the entire global system vulnerable to a Black Swan event that the central banks cannot fix, like a sudden loss of confidence or a non-monetary geopolitical shock. Asterisk day trading psychology in the 2020s asterisk for many young traders. The ability to buy and sell volatile assets instantly and with leverage create a psychological high. They confuse luck with skill and volatility with opportunity. The system rewards this fragile, high-risk behavior until the moment the negative Black Swan arrives, wiping out their capital and reinforcing the ultimate lesson. Never violate the rule of survival. The path forward, anti-fragility and timeless wisdom. The Black Swan does not offer a trading strategy. It offers a philosophical blueprint for survival and thriving in a world of high uncertainty. This blueprint is the pursuit of anti-fragility, a system that gets better with disorder. 1. Embrace redundancy, the power of inefficiency. Modern corporations and financial systems are obsessed with efficiency, just-in-time inventory. minimal capital reserves, highly optimized leverage. Efficiency is the enemy of anti-fragility. Efficiency removes the necessary buffers and redundancies that allow a system to absorb a shock. Taleb would advise the investor to build redundancy into their own life and portfolio. Asterisk a large cash reserve, inefficient in a bull market, but a lifeline during crash. Asterisk genuine diversification into non-correlated assets, gold, real estate, cash, diverse international stocks, even if some are perceived as dead money. Asterisk the convexity inherent in the barbell strategy ensures that the system has two extremes and no fragile middle. 2. Focus on subtraction, the via negativa. The Stoic and Talebian approach is often focused on subtraction, what not to do, which they call the via negativa. You cannot know what will make you rich, but you can know what will make you poor. Asterisk avoid asterisk excessive leverage, believing in expert predictions, being emotionally driven by social media, exposure to catastrophic loss, and confusing luck with skill. Asterisk focus asterisk, removing the known sources of fragility is far more important and reliable than attempting to predict the next source of success. By avoiding the big, career-ending mistakes, you ensure you stay in the game long enough for randomness to eventually work in your favor. The modern environment, with its complexity and hyperspeed, only makes the ancient wisdom of Stoicism and the rigorous logic of the Black Swan more potent. The ability to remain calm amidst the digital chaos, to reject the alluring narratives of the gurus, and to structure your life around the inevitability of the impossible is the single greatest competitive edge an investor can possess today. That is approved. We will now conclude this deep dive with the final, synthesizing reflection and the crucial call to action. Here is part 4, closing reflection, and part V, outro/subscribe CTA for the audiobook-style script. Hashtag glowing star part 4, closing reflection. Target 1 500 2 000 plus words. Sound. The music returns to a deep, resonant, and final-sounding tone, emphasizing gravitas. The journey through Nassim Nicholas Taleb's The Black Swan is not merely an intellectual exercise. It is an act of fundamental financial and psychological transformation. We have stripped away the comfortable illusions of predictability, acknowledged the fraud of the bell curve in scalable systems, and seen how the modern hyperconnected world amplifies fragility. The ultimate takeaway is that wisdom lies not in knowing the future, but in mastering our response to its inherent randomness. The book's lessons are not for the quantitative genius or the seasoned hedge fund manager. They are for every normal person who must navigate a world defined by the highly improbable. The principles are simple, yet profoundly difficult to implement because they require a continuous, humbling act of rejecting the narrative and embracing uncertainty. Here are the 10 timeless principles from the Black Swan, and how any normal person can apply them to their life and investments today. Hashtag 10 timeless principles for the anti-fragile life. Hashtag 1. Reject the narrative fallacy. Principle asterisk, understand that the human mind needs to construct simple, coherent stories to explain chaos. Application asterisk, when financial influencer, a news pundit, or even your own inner voice offers a neat, simple explanation for a complex market move, be suspicious. Train yourself to say, "This happened, and I do not know why." This intellectual honesty is your first line of defense against being emotionally manipulated by false certainty. Never trade based on a satisfying story. Hashtag 2. Beware of Platonic models. Principle asterisk, any model that claims to perfectly represent reality is dangerously incomplete because it necessarily excludes the Black Swan. Application asterisk, be skeptical of any financial product or investment strategy whose risk profile relies on complex, beautiful math like value-at-risk models or options pricing models. Assume that the model only accounts for known variables and is blind to the ultimate catastrophic risk. If you cannot explain the risk simply, do not take it. Hashtag 3. Focus on exposure, not prediction. Principle asterisk, since prediction is impossible in Extremistan, shift your focus entirely from forecasting events to managing your exposure to them. Application asterisk, instead of asking, will the market crash? Ask, if the market crashes 50% tomorrow, will I be ruined? Ensure your structures, your savings, your emergency fund, your portfolio can survive any conceivable negative shock. Survival is the only path to eventual success. Hashtag, 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 hashtag 4. Employ the barbell strategy. Principle asterisk, avoid the fragile middle ground. Maximize safety on one end and high reward. Small bet speculation on the other. Application asterisk, put 80-90% of your investment capital into extremely safe, boring, low-cost assets that are designed purely for preservation, cash, broad index funds. Allocate 10-20% of your capital to highly volatile, scalable, and non-correlated speculative ventures, the positive Black Swan hunt. This ensures your system is structurally anti-fragile. Hashtag, 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 hashtag 5. Practice the via negativa. Principle asterisk, the path to wisdom and safety often involves subtraction, removing known sources of fragility, rather than adding new layers of complexity. Application asterisk, the single greatest piece of financial advice is to avoid excessive leverage. Get rid of high interest debt, and never use margin trading for your core investments. Removing the possibility of ruin is a more powerful and predictable path to wealth than attempting to predict a positive return. Hashtag, 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 hashtag 6. Understand the turkey problem. Principle asterisk, prolonged stability does not guarantee future stability. In fact, it often makes the inevitable correction more violent. Application asterisk, never let success lead to arrogance. If your investment strategy has worked perfectly for 5 years straight, do not increase your leverage or risk. Understand that your success might be due to a long period of favorable market conditions defeating. Prepare for the inevitable Thanksgiving Day, knowing that when it arrives, it will invalidate everything that came before it. Hashtag, 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 hashtag 7. Never confuse scalable and non-scalable. Principle asterisk, recognize the difference between Mediocristan risks, limited impact, like a salary job, and extremistan risks, unlimited impact, like a volatile stock portfolio. Application asterisk, if you have a non-scalable income, a regular paycheck, you have a relatively predictable base. Therefore, use your scalable investment capital, your savings, to intelligently pursue a small amount of positive Black Swan risk. Never, ever use scalable methods like high leverage to fund your non-scalable needs like rent or tuition. Hashtag, 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 hashtag 8. Maximize positive optionality. Principle asterisk, place small, cheap bets that have a potential unlimited upside, while limiting your potential loss to the size of the bet. Application asterisk, this means investing small amounts in many different early-stage, disruptive ideas, from startups to a broad basket of microcap stocks or niche crypto assets. You are not betting on the outcome of any single ticket, but on the statistical inevitability that one of your many tickets will be the non-linear winner. Hashtag, 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 hashtag 9. Embrace the power of redundancy. Principle asterisk, efficiency is an illusion of safety. Redundancy, extra buffers, is the true source of resilience. Application asterisk, hold more cash than you think is necessary, even if it feels financially inefficient during a bull market. That cash is your optionality, the capital you use to buy assets at massive discounts when everyone else is panic selling during a crisis. Redundancy transforms a negative Black Swan into a profitable opportunity. Hashtag, 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 hashtag 10. Cultivate financial stoicism. Principle asterisk, focus solely on what you can control, your process, your exposure, your effort, and accept what you cannot control, the outcome, the market crash, the Black Swan. Application asterisk, separate your self-worth from your portfolio's performance. Maintain emotional discipline during periods of market chaos and social media frenzy. The greatest advantage an investor can have in the age of extremistan is not intelligence, but the calmness and patience to avoid making impulsive, fragile decisions. The ultimate legacy of the Black Swan is not a warning of impending doom, but a profound call to intellectual humility and structural resilience. The book teaches us that uncertainty is not a flaw in the system. Uncertainty is the system. By understanding this, we stop playing the role of the fragile turkey, fattening up for a predictable, catastrophic end. We become the anti-fragile opportunist, the one who is protected from the random shocks that destroy others, and is positioned to profit from the opportunities that those shocks inevitably create. The world is getting faster, more connected, and more volatile. The Black Swans are not getting rarer. They are hitting harder and more often. The only guaranteed path to safety is to stop predicting the impossible and to start preparing for the inevitable. Your goal is not to predict a crash, but to be the one left standing and buying when the crash comes. You have just completed a deep, comprehensive exploration of one of the most vital books of the modern era, a work that completely rewires how we think about risk, fortune, and life itself. The Black Swan is not just about finance. It's about acknowledging the deep, beautiful, terrifying randomness that shapes all human endeavors. It's about building a life and a portfolio that welcomes the unexpected, thrives on chaos, and holds firm when predictable world shatters. We are all on a journey to build wealth, achieve independence, and gain control over our financial future. But control, as Taleb teaches us, is an illusion. Our true strength lies in our resilience, our optionality, and our profound patience. If you absorb these lessons, you move beyond the daily noise, beyond the fleeting FOMO of meme stocks and crypto bubbles, and into a serene, powerful confidence. You move from the turkey to the predator, calmly waiting for the chaos to create your opportunity. If you found value, clarity, and a new sense of discipline in this exhaustive breakdown of the Black Swan, then your next best action is to subscribe to Capitura right now. We are dedicated to breaking down the deepest, most complex financial and philosophical concepts into cinematic, actionable wisdom. We don't chase trends. We uncover the timeless principles that build generational wealth and discipline. Click the subscribe button and turn on notifications. Because next, we're covering another classic that challenges everything you thought you knew about market psychology and long-term asset accumulation, helping you achieve true financial anti-fragility. Thank you for exploring this profound concept with us. We will see you in the next one.